Namaste, Sat Sri Akal and Adab. Welcome back to another episode of One on One with Mr. Bond. My today's guest is Varun Sharma, Fund Manager for Motilal Oswal Digital India Fund. It's a new concept, entirely a new theme as far as I'm concerned, because I'm from the old age side, and I really do not understand this theme a little so much in detail. But Varun is going to throw a lot of light on what is this concept, how is it encompassing mid cap, small cap, large cap, and how is it encompassing all the sectors possible also. On top of that, we'll talk about the penetration in India versus penetration in the global sense, especially in the US context. Welcome, Varun.
Hi, Sunil. Thank you for having me.
So Varun, I'm going to share one trivia with the audience just now. In 1980s, if you see how couples met, it was just a small trivia which I came across on WhatsApp, on Twitter also. So in 1980s, practically all the couples would have met either through friends, family, and some known sources, but 0% through online. Come 2024, practically 61% of couples met through online platforms. It's a huge and a dramatic change as far as the technology usage is concerned. Another trivia which I had shared with many of my friends is in 1980s, I'd gone to visit a friend in Muscat, and first time he showed me what is fax. So from then to now, we've come a very, very long way. So Varun, what is this Digital India space? What are the themes? Let's talk about that first, and then we'll compare the US markets versus the Indian markets.
Sure, Sunil. Sunil, when we talk about digital, these are variety of constructs, be it in the B2C space or B2B space or B2B2C. And these are companies which are basically leveraging digital technologies to reach out to their customers and improve processes, markets, products. Now, we've seen a variety of companies coming in the food tech space. Now, quick commerce is something which has become very hot, gaining a lot of ground from offline as well as the traditional e-commerce. We are seeing companies in navigation. We are seeing companies in financial technologies, insurance tech. Lots of companies which are basically leveraging technology, the digital technology, to become big. Now, as a result, what is happening is that as against the core industry growth, we are seeing that some of these companies are growing uh, at several, they are growing several times faster than the core industries that they are operating in. And this is presenting a great opportunity in front of us because India is quite nascent in terms of digital adoption, digital penetration. Something that we've already seen in the US and China happen over the last 10, 15 years, that some of their digital technology companies have become so big, while the Indian companies have started to gain momentum now. And I think that's a great opportunity for us, having seen what has happened outside, elsewhere, and benefit from the same in India. And that's the opportunity we are talking about when it comes to digital in India.
Sure. So let us compare the US versus the India space. If I understand this correctly, correct me if I'm wrong also. An S&P 500, IT and communication as percentage of S&P 500 is almost 41%, which includes digital technology 32%, communication 9%. And tech stocks market cap in US is now bigger than real estate, consumer staples, industrials, utilities, materials, etc. As compared to that, the index which I can see in the Indian context in the Nifty 50 is about IT software, which is at 17.6%. Are we speaking about the same segment, what we just discussed in the US space versus India? And is that the scope which we are talking about from 17 or 18% to almost going up to 40, 42% in the US context?
Uh, to some extent, that's right. When we're talking about the scope, that is there. But we also have to be mindful of the differences between the Indian economy and the US and Chinese economies, and any other economy for that matter. See, in India, when we are talking about tech, we usually associate with IT services companies, but nowhere else IT services is that big as proportion of the overall index or technology. Uh, when we are talking about digital technologies, we are not specifically talking about IT services companies. We are talking about companies which are leveraging digital technology, internet platforms. These are constructs like SaaS, platform as a service, BPaaS, they're navigation technologies. There is travel tech. So these are several technology companies that are emanating across various verticals and across various industries.
So
They do
it's
not
not
function.
IT the way we see digital technology in the Indian context. It's much beyond that.
Absolutely. Now in India, we observe that IT services industry has become very big. So we typically associate technology with IT services. But when we are talking about Motilal Oswal Digital India Fund, we are not talking about IT services. We are talking about these digital technologies that have become, uh, you know, pretty big in the US or any other large market. And this is where we are seeing an opportunity in India.
Sure. So right now we are saying that it's a zero point 0.3 trillion digital GDP, which is 8% of Indian GDP of 3.75 trillion in 2024, and likely to grow to almost 1.2 trillion, which is almost 1x growth in the GDP of India versus 4x growth of digital GDP of India. So if you can throw some light on that, and what are we talking about, and the scope here?
See, basically, there have been uh, there are a lot of data points that we look at when we're talking about how digital is penetrating across the entire country and across various verticals. Now, when we're talking about GDP, GDP is nothing but an aggregation of GDP of several industries, right? And then you put agriculture, manufacturing, services, all the industries together, and that's how you get your GDP. And when we're talking about digital GDP, we're essentially talking about the transactions, revenues, business of companies which are digitally oriented. And as I said earlier, that some of these digital companies are growing several times faster than their core industries' growth. In that case, we are seeing that digital GDP of the country is growing at an accelerated pace as compared to the overall GDP. And
Sure.
this is the penetration that we're talking about will continue to increase or go up over time, not just for a few years, but multiple decades.
Right. So now we are talking about four pillars of digital pillars, basically, in terms of the digital technology and the digital space, so to say. The smartphone users, almost 1,013 million users, 72.3% penetration. High-speed internet users, 751.5 million users, 52.4% penetration. UPI users, 350, 25% penetration. And scaled business have been reaching majority of the population. Now, these are the four pillars. If you can throw light on these numbers, and the penetration is quite substantial according to the data which we have just talked about.
See, essentially, when
Except for UPI, where we have just started and we are at 25%.
that's correct. See, essentially, when we're talking about a digital ecosystem, smartphones are quite key to that because they allow you to be mobile at the same time while making all your transactions and doing business processes and even at the retail level. So smartphones are quite key. Second is that essentially you need a good level of high-speed mobile internet penetration as well, because unless you have that kind of bandwidth to be able to transact and do business processes online using your smartphones or tablets, essentially then the enablement doesn't happen. The third aspect is basically the digital businesses that when people are looking for services, products, or offerings online, we should have enough scaled digital businesses which can basically fulfill the demand. The fourth aspect, which has been sort of like a challenge for India, was essentially the payments ecosystem. Because if you look at most of the other countries outside, especially the developed world, payments has not been an issue. People have been extremely comfortable using their credit cards. There were super apps, there were wallets, and that has actually put the other pillars together and has enabled digital penetration to a large extent. Now, India suffered because of this because the credit card penetration remained low, and we could not really find one-stop solution the way, let's say, the US has in terms of credit card or PayPal or Apple Pay, Venmo, etc. But with UPI, we've solved for it. So while you talked about those four pillars, what we really see is that across the three pillars, which is mobile phone, smartphone penetration, high-speed internet, digital businesses, India has sort of moved in tandem with some of the largest economies globally.
Yeah, I
We actually
assume
lack
so.
Where we actually lagged was essentially the payments infrastructure, which we have solved for now with UPI.
Now there are exponential opportunities. Now you spoke about B2C, B2B, etc. So the B2C e-commerce is good. Like right now, 5x to 6x is the exponential opportunity which we are looking at. So if currently we are at 60 billion in the e-commerce space, we are likely to grow to almost 350 to 380 billion in by 2030. So let's talk one by one, and if you can give some examples to the viewers, because it's since it's a new space. Of course, B2C e-commerce people will understand, but if you can give some names, naturally these are not recommendations, and we are not saying that this is part of your model portfolio, but some names which people will relate to in the B2C space.
Sure. See, in the B2C space also, when we talk about e-commerce, e-commerce also has several aspects. There are companies which are completely horizontally driven, which are the likes of Amazon and Flipkart and all in India. Then there are certain companies which have carved out certain segments or niche. Like for instance, you have, we commonly use FirstCry for kids clothing and kids accessories. We have Nykaa, which is quite a prominent player in BPC space. So similarly, we have Mamaearth, which has carved out its own niche. So what we see is that even in B2C spaces, there are companies which have carved out their niches. Now, uh, there is food tech where you have the largest companies, Zomato and Swiggy, which are delivering food to people.
So
Then
that
we
will
have
come in the food delivery space. So B2C, the food delivery space comes under the B2C only again?
yes, absolutely. So anything which is delivered directly to the end retail customer comes under the B2C space.
Right.
Uh, Then there are companies in insurance like Policy Bazaar, which is selling insurance to, individual customers. So there are several models that we have seen that emanated because see, we have to also appreciate the fact that India is a very large market, right? With more than 160 crore people, you really need a very small fraction of population adopting
I
and
know.
doing the segmentation enough to create a very sustainable and large business out of this population.
Correct. Now let's talk about the, one is the B2C space. The other one, which we had scope, which is online travel. Currently, almost 13 to 15 billion, likely to grow by 4 to 5x, and 35 to 60 billion is the market space as far as online travel is concerned. So some names there also, so people relate to that.
See, when we look at most of these OTAs, the online travel agencies, some of them have become obviously one large player now is Make My Trip, uh, which merged with Goibibo. That was almost 8 9 years back, and is now the dominant player in the B2C online travel, right, the retail. But some of the other companies which we also know the names, we know names like Yatra, ClearTrip. They have a decent presence in the B2B travel space.
Right.
So in each and every industry, there is scope for B2C as well as B2B. So essentially, these are the opportunities that are emanating. Now, B2C is something that has been sort of taken by one large player now and with a dominant market share. And this is some observation that we typically see, when once the equilibrium sets in, that one large dominant player is there in these B2C categories, unless it is very, very niche or segmented, it's a different game. And that's on the travel side. Now, in travel, the other opportunity also is that it is not just about online travel, but it's about travel all put together. What we saw in China that, when the average incomes went up, which is something that we're observing in India, people tend to travel internationally a lot. And as compared to the domestic travel, international travel is several times more or several times higher when it comes to the ticket sizes. So while the volumes, let's say go up X number of times, uh, the transaction values can go up several times more than, the volumes. So that's the opportunity in the travel side as well.
Then online media, some names there.
See, online media is something which has been sort of again. So we have a sort of democratic presence here when it comes to B2C. What we have normally seen is that when it's just pure digital media space, it has been dominated by some of the US giants like Meta, through WhatsApp, through Instagram, through Facebook, and then you have Google with YouTube. You also have Twitter. Then there are certain classified space in the media, overall media industry, which has been taken over by some of the Indian companies, right? So, for instance, in the B2B classified space, we have players like IndiaMart and Just Dial. In the B2C job classified space, we have Naukri.com. So that's how, some of the companies are taking their share away in the media space. But as I said, it's quite democratic. You have presence of large US organizations as well as the Indian organizations.
Sure. So, and then finally, of course, the online food delivery and the online healthcare. So these are the segments which we are talking about where there is a linear growth, GDP growth in different segments. Now, what I wanted to understand, since it's a new space for all of us, is this large cap oriented, mid cap oriented, small cap oriented space?
See, it's an opportunity oriented space, but just by the virtue of this space being relatively nascent in India, the companies are smaller. Uh, See, if we go 10, 15 years back in the US or even in China or some of the larger economies, we will see. So we are where those countries were 10, 15 years back in terms of the size of or scale of digital businesses. So because it's nascent, most of the companies tend to fall under that small and mid-size arena.
So now, since you're saying that there are small and mid-sized companies as far as the sector or the market cap allocation is concerned, where do you see their valuations at the current juncture?
So there has been a big debate and a challenge around the valuations of these companies. And as industry participants, we've had a publication only in this regard, that time and again what we've seen is that uh, the existing valuation methods or frameworks have sort of not worked when it came to internet companies and it came to new economy companies. Now, apparently, the existing valuation methods, be it on income based, cash flow based, or asset based, or even the convenience multiples that people use, they have stood the test of time for the past century, as in when new industries came in, whether it was railroads or electric utilities, or FMCG companies or manufacturing companies. But when the new economy digital companies became mainstream, these valuation methods did not work. And a lot of fundamental value-driven investors have found it extremely challenging to value these companies using those methods. If we go back, 10, 15 years, even in the US or elsewhere, and we look at the growth, journey of these digital companies, what we have observed is that the same mistakes were made by investors earlier, that they viewed these companies with the same existing valuation methods, that the same lens they kept on wearing. So what we have done is that we have created our own econometric models, our own proprietary models to value these companies. It's a very difficult task, but one has to do it given the opportunity. Now, if we will continue to value these companies with the traditional metrics, time and again we'll find it difficult because it's
So
extremely challenging.
sorry to interject, but am I hearing something similar to what happened in 99, 2000 when the dot-com bubble was, just growing and becoming bigger and bigger, and finally we know what happened to that. That time also people said we have to value these companies differently, whether they have profit or loss or whatever. They were still valued at multiples of their possibility of earnings growth, etc. So are we seeing something similar, or is there a difference in what the companies were then versus companies now and the valuation metrics which you're talking about?
So this time is more comparable to the 2006, 7, 8 time frame and
Okay.
than the dot-com bubble. Uh, See, markets have a way of anticipating things in advance and trying to play on that. But let's come back to the four pillars of digital ecosystem, and I'll ask you one by one so that you can answer.
Sure.
Let's compare the times during dot-com bubble and 2006, 7, 8. During 2006, 7, 8 versus the dot-com bubble, during dot-com bubble, did we have smartphones?
Right.
Palm was trying, they failed. We did not have. Did we have good enough bandwidth, high-speed internet available that time?
Sure. I
We did
hear
not,
you.
right? Did we have reasonably scaled digital businesses that time?
So that means the infrastructure for this space has developed and evolved from 2000 to now. We are in a different space altogether, is what I hear you say.
So when you're talking about digital ecosystem, the digital rails have to be put into place for the digital train to run. And digital rails were put in around the time frame of 2006, 7, 8, when the smartphones became mainstream, essentially when the iPhones came out, when the Android phones came out, and the app ecosystem became mainstream. Digital rails were put through the high-speed mobile internet. Digital rails were put through the scaling up of digital businesses, and digital rails were put through the the ecosystem, the payment ecosystem being available to the mainstream population. So because people had the same, I would say experience of .com, 10 years later, when the digital rails were already put in place, a lot of them actually missed out on investing in this space. And a lot of people have continued to make the same mistake that instead of finding the right valuation methods, frameworks for these companies, we still do tend to compare these times with the .com uh, uh, period.
Sure. Now tell me, can we call it a thematic fund or a sectoral fund, or it is encompassing many sectors and many themes? So it
Uh,
can't be treated as a thematic or just a sectoral fund, because a lot of investors don't like to be in a thematic or a sectoral fund. But what I hear you say is that it is encompassing a lot of industries, a lot of sectors, and a lot of market caps also.
right. See, when we say sectoral, we are typically talking about an industry. But when we say thematic, thematic does not need to, sort of constrict or constrain itself to an industry. So it is a thematic fund, but it is at the same time quite diversified across industries and across market capitalizations.
Understood.
So what we have essentially done is in this fund, or what we intend to do is that we want to find those fast growing digital technology companies across industries that are gaining share, that are growing several times faster than those core industry growths, and assembling them all together, which are essentially sustainable businesses, or we believe that they will be quite sustainable in the long run.
Sure. Now, your parting thoughts, how do you foresee to continue in this 2025, which is likely to be choppy in terms of the equity markets, global factors, the geopolitical issues, etc., etc. How will you as a fund manager weave through this choppiness for maintaining the performance of this particular fund? Naturally, it's too short a period for me to even talk about or compare it. But how do you, what should let me put it the other way around. What should the investors expect from this fund over the next couple of years, especially 2025?
See, essentially, what we do as investors is that it is also very difficult for us to time near-term movements when we talk about 6 months, 1 year, or something like that. The real returns, and as this is something that uh, Motilal Oswal has always been wedded to, real returns are always made when you get business compounding, and business compounding is something that you can bank on because valuations is something that you would expect, that valuations would improve as businesses become more sustainable, but that is not something that you can call out very methodically always. So the first or the primary pillar of returns is nothing but business compounding. As long as businesses are compounding, markets will at some point of time take cognizance of the same. So what we are essentially looking at is not just the stock prices going up, but how much are the businesses compounding vis-a-vis the stock prices.
Yeah,
Now, if the stock prices go up, at a particular rate, and businesses are compounding at rates faster than stock prices, and inherently valuations are becoming cheaper,
correct.
and that gives us an opportunity to invest on those in those businesses and companies where business compounding is faster than the stock compounding.
Understood.
And what we are seeing in this space is more often than not, we find many opportunities where stocks may have gone up, but businesses have compounded faster than the stock prices, thereby giving us that valuation comfort that yes, these are sustainable businesses at the end of the day where we would like to invest in, but valuations have inherently become cheaper.
So
And so we
again,
can
PEG will be one of
increase
the
our,
criteria of you to select the stocks,
sorry.
PEG ratio.
See, the PEG ratio essentially talks about PE and growth in earnings. PEG ratio can also
Basically.
Yeah. So PEG ratio can also be modified to look at other metrics of business compounding. We
Okay.
may not get near-term earnings. We may get near-term EBITDA growth, profitability growth, or sales growth, or the quality of business is improving. It is becoming multi-line business. So these are the things also that we have to keep under consideration. In scaled up businesses or linear businesses, typically where the deviations are not too high, PEG ratio is a very good metric to use. No doubt about that. But when it comes to digital, where earnings remain quite choppy and quite volatile, which actually troubles investors a lot, there are other metrics also that we have to be quite mindful of.
Perfect. Great, Varun. Thank you so much, and all the very best for continuous success on this particular fund, and may this fund grow both for the investors' wealth as well as for Motilal Oswal as an asset management company also. Thank you so much.
Thank you so much, Sunil.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.